Hey everyone, and welcome back to the Deep Dive. Today we're going to be taking a deep dive into equity valuation.
Yeah, a very important topic for the CFA Level 2 candidates.
Absolutely. I mean, not only is it something that you need to know for the exam,
Mm,
but it's also just like a really important skill to have in general if you want to understand how the stock market works.
that's right.
So we're going to be focusing on the dividend discount model, or DDM.
Mm,
We're going to break down how to actually put a price tag on a company's stock. And we're going to do our best to, make it as clear and understandable as possible.
yeah, we'll unpack all the jargon,
Yeah.
and try to show how this stuff actually works in the real world.
Sounds good to me. So where do we even begin with something like equity valuation? It feels like there are so many moving parts.
Yeah, well, I mean, the foundation of it all is the concept of present value.
Okay.
So think about it this way, a dollar today is worth more than a dollar tomorrow, right?
Right.
Because you can invest that dollar today and earn a return on it.
Right. Time value of money, classic.
Exactly. So, and that's the same principle that we apply when we're valuing a company. We're trying to figure out what all those future cash flows the company is expected to generate, what are those worth to us today?
Okay. So we're bringing those future cash flows back to the present.
That's right.
But a company's future is uncertain. How do we deal with that?
Yeah. That's where things get a little bit more complex.
Okay.
So, unlike valuing something like a government bond where the cash flows are pretty much guaranteed,
Right.
valuing a company's stock, involves a lot more risk. We have to factor in the possibility that those future cash flows, might not materialize as expected.
So how do we adjust for that risk?
Well, we use something called a discount rate.
Okay.
So this rate reflects the riskiness of those future cash flows.
Yeah.
The higher the discount rate, the more we're discounting those future cash flows, the lower the present value.
Got it. So the riskier the company, the higher the discount rate,
Exactly.
the lower the present value of its future cash flows.
That's right.
Makes sense. Now, how does the dividend discount model fit into all of this?
Yeah, so the DDM is one of the most common ways to value companies that pay dividends.
Okay.
It's based on the idea that the value of a stock today is equal to the present value of all the dividends it's expected to pay out in the future.
Okay. I think I'm following. But forecasting dividends into the future sounds pretty tough.
Yeah.
Companies can change their dividend policies. Their earnings can fluctuate. Who knows what the economy will do?
You're absolutely right. I mean, that's why we often make simplifying assumptions,
Yeah.
to make the DDM, more manageable.
All right. Let's talk about some of those assumptions. I've heard of the Gordon growth model.
Okay.
What's that all about?
Yeah, the Gordon growth model is a classic.
Okay.
It's the simplest form of the DDM. And basically what it assumes is that a company's dividends will grow at a constant rate forever.
Forever.
Yeah.
That seems like a pretty big assumption.
It is a big assumption. But even with its limitations, the Gordon growth model can be a very useful tool. Okay. For valuing companies with stable, predictable growth patterns,
Ah.
especially if we're just looking for a ballpark estimate.
Okay. So how does it work?
Mm-hmm.
How do we actually calculate the value of a stock using this model?
Yeah. So the formula itself is pretty straightforward.
Okay.
You take the next year's expected dividend.
Okay.
You divide it by the difference between the required rate of return and the constant growth rate.
Okay. So we need three things. We need the expected dividend.
Yes.
We need the required rate of return, and we need that constant growth rate.
Yep.
So let's break those down. So starting with the expected dividend, how do we figure that out?
Yeah. So we can look at the company's history of dividend payments,
Okay.
their current earnings, their stated dividend policy to get an idea of, what we expect them to pay out in the future.
Okay. And the required rate of return, that sounds important.
Yeah, that is very important.
Okay.
So that's the return that investors demand for holding the stock, given its risk. It considers things like the risk-free rate of return, the market risk premium, the stock's beta, which measures its volatility relative to the overall market.
Right. So riskier stocks will have a higher required rate of return.
Exactly.
Makes sense. Now, what about that constant growth rate? That feels like maybe the trickiest part.
Yeah, it can be tricky. And we need to be realistic here.
Yeah.
Assuming constant growth forever is a simplification.
Right.
In reality, companies go through different stages of growth.
Of course. Yeah.
They might experience rapid growth initially, followed by a period of slower growth as they mature.
So how do we choose a realistic growth rate for the Gordon growth model?
Yeah, so we need to look at the company's historical growth rates.
Okay.
Their industry dynamics, their future prospects. We also need to consider factors like inflation and the overall growth of the economy.
Okay, this is getting complex.
It is.
Are there any real-world examples where the Gordon growth model has been used to value companies?
Absolutely. Yeah. So you could take a company like Sunoco Products. They're a manufacturer of packaging materials.
Okay.
They've had a pretty consistent dividend policy paying out a portion of their earnings regularly. So if we believe that their earnings are going to continue to grow, at a rate similar to maybe a little bit lower than the overall economy,
Hmm.
we could use the Gordon growth model to get a rough estimate of what their value should be.
Interesting. So we're looking for companies with stable, predictable growth patterns.
That's right.
What about a utility company like MSEX? They provide water services and have a history of paying steady dividends. Would they be a good candidate for the Gordon growth model?
They might be, yeah. Their business is relatively stable.
Right.
Their growth is likely to be tied to, population growth and economic activity in their service area.
Ah,
But even with a company like MSCX, we still need to be mindful of, those assumptions about future growth
yeah.
and the required rate of return.
Okay. I'm starting to see how the Gordon growth model can be a useful starting point, but it's important to remember those assumptions
Absolutely.
and its limitations.
Exactly.
It's not just for individual stocks either.
No,
We can also use it to value things like broad market indexes or even certain types of preferred stock.
that's right.
Makes sense. Those types of assets tend to reflect average economic growth rates and have, more predictable growth patterns. So the Gordon growth model might be a reasonable way to at least estimate their intrinsic value.
Yeah.
But what about something like share buybacks? Don't those complicate things?
They do.
Yeah.
Yeah. Share buybacks have become a very popular way for companies to return value to shareholders.
Okay.
But they can throw a wrench into traditional dividend discount model calculations.
How so?
So imagine, a company has $100 million to distribute to its shareholders.
Okay.
They could either pay it all out as dividends or they could use some of it to buy back their own shares.
Right.
If they choose to buy back shares, well, the number of outstanding shares decreases. And that can lead to a higher dividend per share, even if the total amount of dividends paid stays the same.
So buybacks can make it look like the dividend is growing faster than it really is?
Exactly. And unlike dividends, which tend to be announced and paid out, on a regular schedule,
Right.
buybacks can be a lot more unpredictable. Companies might time them strategically based on market conditions, which makes it harder to factor them into, long-term forecasts.
Okay, so how do we deal with share buybacks when using the DDM?
Well, there are a few ways.
Okay.
One approach is to, calculate what's called the implied dividend growth rate,
Okay.
taking into account things like the current stock price, the company's earnings, the amount they're spending on buybacks.
Right.
And this can give us a more realistic estimate of how much the dividend is likely to grow, considering the impact of those buybacks.
That makes sense, but it sounds like we still need to be careful about making assumptions,
Oh, absolutely.
especially when it comes to predicting those buyback programs.
Yeah, forecasting is always going to involve some degree of uncertainty.
Sure.
But that's part of what makes, equity valuation, both challenging and interesting.
Okay, I'm with you on that. But here's a thought that's been bugging me.
Okay.
Does strong earnings growth always mean a higher stock price?
That's a good question.
It seems like there should be more to it than that.
You're right, there is more to it. It's not just about growth, it's about profitable growth.
Okay, now I'm really intrigued. Tell me more.
All right, so let's say we have two companies. Both of them are growing their earnings at 10%.
Oh.
But one company is earning a return on equity, or ROE, of 15%.
Okay.
The other one's only earning 5%. Which company do you think is creating more value for its shareholders?
I'm going to guess the one with the higher ROE, but I don't know why.
Okay, because they're generating more profit for every dollar invested by shareholders.
Oh.
So for growth to truly drive a higher stock price, it needs to be profitable growth. The return on equity needs to exceed the cost of equity.
So in our example, the company with the 15% ROE is exceeding its cost of equity,
That's right.
while the company with the 5% ROE is falling short.
Exactly. And that brings us to an important concept called the present value of growth opportunities, or PVGO.
PVGO, that sounds kind of intimidating.
Yeah, it sounds a little bit intimidating, but it's not as complicated as it sounds. So the PVGO represents the value that investors place on a company's future growth prospects. It's the difference between the company's total value and the value of its assets in place.
Okay, so if a company has a high PVGO, it means investors are optimistic about its potential for profitable growth in the future.
Exactly. A high PVGO suggests that investors believe the company has a lot of opportunities, to invest its earnings and generate returns that exceed their cost of capital. On the other hand, a low PVGO might signal that the market is skeptical about the company's ability to generate value from its growth, maybe because they're in a mature industry or facing tough competition.
This is starting to make a lot more sense. So we've talked about the Gordon growth model, which assumes constant growth forever.
Right.
But we know that's not always realistic.
Yeah.
What do we do if we want to value a company that's likely to go through different stages of growth?
Yeah, that's a great question. And that's where multi-stage dividend discount models come in.
Oh, yeah.
They allow us to be a little more nuanced and realistic in our evaluations.
Tell me more about these multi-stage models. What are they all about?
So instead of assuming a single constant growth rate for ever multi-stage DDMs, allow us to break down a company's future into distinct phases,
Okay.
each with its own growth rate. So for example, we might have a high growth phase, followed by a transition phase, and finally a mature phase with more stable long-term growth.
Okay, that sounds a lot more realistic than assuming constant growth forever.
Yeah.
So how do we actually go about building one of these multi-stage models?
Yeah, so let's start with one of the most common ones, which is the two-stage DDM.
All right, two-stage DDM, let's dive in.
So the two-stage DDM, as the name suggests, assumes two distinct growth phases for the company.
Okay.
First, we have the high growth phase, where the company might be expanding rapidly, getting market share, investing heavily in research and development.
Right, that makes sense.
Yeah.
What happens after that high growth phase?
Well, eventually that rapid growth is going to slow down as the company matures, competition increases, and its market becomes more saturated.
Right.
That's where the second stage comes in the mature phase.
Okay, so the two-stage DDM recognizes that companies don't grow at the same rate forever.
That's right.
How do we actually use this model to value a company?
So it involves a few steps. First, we need to forecast the dividends for that initial high growth phase.
Okay.
This requires some careful analysis, of the company's financials, their industry, their competitive landscape.
So we need to project those dividends year by year for the high growth period.
Exactly. And once we've done that, we can move on to estimating the terminal value of the stock
Okay.
at the end of that high growth phase.
Terminal value, what's that?
Yeah, so the terminal value represents the present value of all the dividends the company is expected to pay out from that point forward,
Okay,
assuming a constant growth rate during the mature phase.
got it. So we're basically using the Gordon growth model to estimate the value of the company at the end of the high growth phase.
Exactly. We're assuming that once the company reaches maturity, its growth will stabilize, and we can use a constant growth model to estimate its value from that point onward.
Okay, so we've forecasted the dividends for the high growth phase.
Right.
We've estimated the terminal value.
Yep.
What's the next step?
So now we need to discount both those dividends from the high growth phase
Okay.
and that terminal value back to today
Yeah.
to get the total present value of the stock. Remember, we're using a discount rate that reflects the riskiness of the company's cash flows.
Right, time value of money strikes again. We're bringing all of those future cash flows back to the present.
That's right.
But what if we want to be even more nuanced in our modeling? What if the transition from high growth to mature growth isn't so abrupt?
Yeah, that's a great question. So there are a couple of more advanced techniques that we can use to model more gradual transitions in growth rates.
Okay.
One of them is called the H model.
The H model, what's that all about?
So the H model is a variation of the two-stage DDM.
Okay.
Instead of assuming an abrupt drop in the growth rate at the end of the high growth phase,
Right.
the H model assumes a linear decline in the growth rate over a specified period,
Okay.
which can be more realistic for some companies.
So instead of a sudden drop-off, we're modeling a smoother transition
That's right.
from high growth to a more stable, mature growth rate.
Exactly. And this can be particularly useful for companies that are expected to go through a period of, gradual deceleration in their growth.
Okay, that makes sense. Is there another advanced technique for modeling more complex growth patterns?
There is. It's called the three-stage BDM. As you might guess, this model incorporates three distinct growth phases.
3 stages, okay. All my ears.
So the first and third stages are similar to the two-stage model.
Okay.
We have a high growth phase and a mature phase with a constant growth rate.
Okay.
But in between, we have a transition phase,
Right.
where the growth rate can either be constant or decline linearly, just like in the H model.
Wow. So the 3-stage DDM gives us even more flexibility to model how a company's growth might evolve over time.
It does, and that can be really helpful for valuing companies with, long and dynamic growth trajectories.
Right.
We can model periods of rapid growth, followed by periods of gradual deceleration, and finally periods of stable, mature growth, all within the same model.
Okay, I'm starting to feel like a DDM pro. But what about companies that don't pay dividends at all? Can we still use these models to value them?
Yeah, that's a great question. It might seem counterintuitive to use a dividend discount model for a company that doesn't pay dividends.
Right.
But the key is to remember that, even if they're not paying dividends now, they might start doing so in the future.
So we can still apply the principles of the DDM even if the first few years of our forecast have zero dividends.
Exactly. We can use a multi-stage DDM where the first stage assumes zero dividends.
Okay.
Then we project when the company might start paying dividends and at what rate those dividends might grow once they're initiated.
Okay, that makes sense. But to accurately forecast those future dividends,
Hmm.
we really need to understand what drives a company's growth in the first place, right?
Absolutely. And that's where concepts like the sustainable growth rate and DuPont analysis come into play.
All right, let's unpack those. Starting with the sustainable growth rate, what is that?
So the sustainable growth rate is the rate at which a company can grow its earnings and dividends without having to issue new equity or change its capital structure.
Okay.
It's basically the maximum rate of growth a company can sustain using only its internally generated funds.
So it's the growth a company can achieve without having to go out and raise more money from investors.
Exactly. And it depends on two key factors: the return on equity, ROE, and the earnings retention ratio.
Okay, remind me again what the earnings retention ratio is all about.
Right. So the earnings retention ratio is the proportion of earnings that a company plows back into its business instead of paying out as dividends.
Okay.
The higher the retention ratio, the more fuel the company has to drive its growth.
So if a company has a high ROE and a high earnings retention ratio, it should have a high sustainable growth rate.
That's the general idea. But to really understand the drivers of ROE, we can use something called DuPont analysis.
DuPont analysis, what's that all about?
So DuPont analysis is a powerful tool that breaks down ROE into its key components. It helps us understand, what's really driving a company's profitability and how that might translate into future growth.
Okay, I'm ready to break it down. What are those key components of ROE?
All right, so DuPont analysis tells us that ROE is a function of three things: profit margin, asset turnover, and financial leverage.
Okay.
By analyzing each of these components, we can get a much clearer picture of what's contributing to a company's ROE.
Let's take them one by one. What's profit margin all about?
So profit margin is a measure of how much profit a company generates for every dollar of sales.
Okay.
A higher profit margin means the company is more efficient at controlling costs and generating profits from its operations.
Makes sense. So higher profit margins are generally a good sign. What about asset turnover?
So asset turnover measures how effectively a company is using its assets to generate sales.
Okay.
A higher asset turnover means that the company is squeezing more sales out of its existing assets, which can be a sign of efficiency and effective management.
Okay, I see how that's important. And finally, we have financial leverage.
Right. So financial leverage measures how much debt a company is using to finance its assets.
Right.
Higher leverage can amplify returns, but also comes with higher risk.
Right, so too much debt can be a problem.
Exactly. So by understanding the interplay of these three components, profit margin, asset turnover, and financial leverage,
Yeah.
we can get a much deeper understanding of what's driving a company's ROE.
And that deeper understanding can help us make more informed forecasts about future growth rates, which in turn can feed into our DDM valuations.
Exactly. It all comes back to understanding the underlying drivers of a company's performance and using that knowledge to make more informed investment decisions.
This has been incredibly insightful. We've covered a lot of ground, from the basics of present value in the DDM
We have.
to the nuances of multi-stage models and the financial drivers of growth. I feel like I'm starting to see the bigger picture.
I'm glad to hear it.
Yeah,
But remember, we've only just scratched the surface.
of course. Yeah.
There's so much more to explore when it comes to equity evaluation.
Well, luckily for us, we have more time to dive deeper into this fascinating world.
That's right.
All right, welcome back to the Deep Dive. Before the break, we were, exploring all sorts of ways to value a company using the dividend discount model, or DDM for short. We covered everything from the classic Gordon growth model to those more complex multi-stage models.
And we even tackled, how to deal with those pesky share buybacks that can sometimes distort the picture.
Right, exactly.
But remember, these models are just tools, and like any tool they have their limitations.
Right, we need to be mindful of those assumptions we're making about growth rates, discount rates, and all those other inputs that go into these models.
Exactly. And that's why it's so important to understand the underlying drivers of a company's financial performance. The more we know about a company's profitability, its efficiency, its financial health, the better equipped we are to make informed judgments about its value.
Okay, I'm with you on that.
Yeah.
So what are some other things we should be thinking about when it comes to equity valuation?
Well, one thing that often comes up is the concept of relative valuation.
Okay.
So this is where we compare a company's valuation to that of its peers or to industry averages.
So instead of trying to come up with like an absolute value for the company, we're looking at how it stacks up against similar companies.
Exactly. So relative valuation can be a useful way to kind of get a quick sense of whether a company is overvalued or undervalued relative to its peers. And we often use what are called valuation multiples for this. Things like the price to earnings ratio or PE ratio.
Right, the PE ratio, that's a classic.
Yeah.
It tells us how much investors are willing to pay for each dollar of a company's earning.
Oh, exactly. And by comparing a company's PE ratio to that of its peers, we can get a sense of whether it's trading at a premium or discount.
Okay, so if a company has a higher PE ratio than its peers, it might be overvalued.
Potentially, yeah.
If it has a lower PE ratio, it might be undervalued.
That's the general idea, but we need to be careful about jumping to conclusions. There could be valid reasons why a company might trade at a higher or lower PE ratio than its peers.
Right, things like differences in growth rates,
Yeah.
risk profiles, or even just, different accounting practices
Exactly.
can all affect those valuation multiples.
That's why it's so important to dig deeper and understand the story behind the numbers.
So relative valuation can be a useful tool,
It can be.
but it's not a substitute for thorough fundamental analysis.
Absolutely. It's all about, combining different approaches and looking at the bigger picture.
Okay, I'm starting to feel like I'm getting a handle on this equity valuation stuff,
Good.
but I'm sure there were still some, nuances and challenges that we need to be aware of.
Oh, there always are. Equity valuation is not an exact science.
Right.
It involves making assumptions, dealing with uncertainty, interpreting complex information.
So what are some of the common pitfalls or mistakes that people make when they're trying to value companies?
Yeah. Well, one common mistake is getting too caught up in the numbers and losing sight of the qualitative factors that can drive a company's performance.
Okay, so we need to consider things like the quality of management, the strength of their brand, their competitive advantages, their overall strategy, all that kind of stuff.
Exactly. Those qualitative factors can be just as important as the quantitative ones when it comes to assessing a company's long-term value.
Another mistake I've heard about is relying too heavily on short-term trends or market sentiment.
Yeah, that's a big one. The market can be fickle.
Right.
Stock prices can fluctuate wildly in the short term based on, news headlines, investor emotions, even just random noise.
So we need to kind of, try to block all that out and focus on the long-term fundamentals of the business.
Exactly. Focus on the fundamentals. Try not to get swayed by the short-term swings. As Benjamin Graham, the father of value investing, famously said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine.
I love that quote. It's a great reminder to focus on the intrinsic value of a company rather than trying to guess what the market might do in the short term.
Exactly.
What about failing to properly account for risk?
Yeah, that's another common mistake.
Okay.
Investors often underestimate the riskiness of certain investments or fail to diversify their portfolios adequately.
Right. We need to remember that risk and return are two sides of the same coin.
That's right.
Higher potential returns typically come with higher risk.
And that's why it's so important to carefully assess the risk profile of any investment, before putting our hard-earned money into it.
Okay, I'm taking notes.
Yeah.
What about some of the ethical considerations in equity valuation? It seems like there's potential for, bias or conflicts of interest to kind of creep in.
Yeah, you're absolutely right. Ethics are paramount in the investment profession, and equity valuation is no exception.
Yeah.
Analysts have a responsibility to be objective, independent, and transparent in their work.
So they need to avoid conflicts of interest, disclose any potential biases, and base their valuations on, sound research and analysis.
Exactly. It's all about, maintaining the integrity of the profession and ensuring that investors have access to reliable and unbiased information.
Okay, I'm really glad we touched on that. The ethical side of things.
Yeah.
It's a critical part of being a responsible and successful investor.
Absolutely. And it's something that every CFA candidate should be thinking about as they prepare for their exams and their future careers.
This has been an incredibly informative and engaging discussion.
It has been.
I feel like I've gained a much deeper understanding of equity valuation and all the, many factors that go into it.
I'm glad to hear it. But remember, the learning never stops in the world of finance. There's always something new to discover, some new challenge to tackle, and some new insight to gain.
Welcome back to the deep dive. We're wrapping up our deep dive into equity valuation. I feel like we've covered so much ground already, from the foundational dividend discount model to the complexities of share buybacks and even, those important ethical considerations.
It's been quite a journey. We've explored different valuation techniques, we've dissected financial statements, we've even touched on the psychology of the market. But there's one crucial aspect of equity valuation that we haven't really discussed yet. And that is, how to actually apply all this knowledge to make real-world investment decisions.
That's a great point. After all, the ultimate goal of, all this analysis is to identify good investment opportunities and potentially outperform the market.
Exactly. And that's where things get really exciting. Think of equity valuation as a treasure hunt. We're using all these tools and techniques to search for hidden gems, companies that are undervalued by the market.
So we're looking for those diamonds in the rough, the companies whose true worth isn't reflected in their current stock price.
Precisely. And when we find them, that's where the potential for profit lies. We can buy those undervalued companies and hopefully watch their stock price rise as the market eventually recognizes, their true value.
Okay, I'm starting to see the connection between, all this theory and the real-world practice of investing. But how do we actually go about finding those undervalued companies? It seems like kind of a daunting task.
It can be, but that's also what makes it so rewarding. There are a number of approaches that investors use. Some focus on specific industries or sectors that they understand really well, looking for companies with strong fundamentals, competitive advantages that the market might be overlooking.
So they're doing their homework, digging deep into, company reports, industry trends, competitive dynamics.
Exactly. Others might use quantitative screens, to filter through vast amounts of data, searching for companies with particular financial characteristics that suggest undervaluation.
Like a low price-to-earnings ratio, strong cash flow, or high return on equity.
Exactly. And of course, many investors combine both qualitative and quantitative approaches, using a blend of research analysis and judgment to identify potential opportunities.
Okay, so there's no magic formula. It's about developing a process, doing your due diligence, and being patient.
Absolutely. And it's important to remember that even with the best research and analysis, there's always an element of uncertainty in investing. We're dealing with the future, which is inherently unpredictable.
Right. So we need to manage our risk, diversify our portfolios, and just be prepared for the unexpected.
Exactly. And that's where, experienced temperament and a strong understanding of risk management principles come into play.
This has been an incredible deep dive into the world of equity valuation. I feel like we've covered everything from the theoretical foundations to the practical applications and, even those ethical considerations.
It's been a pleasure exploring this fascinating topic with you. And I hope our listeners feel empowered, to apply these concepts to their own investment journeys.
I couldn't agree more. And remember, equity valuation is the continuous learning process. There's always more to learn, more to explore, and more to discover.
So keep asking questions, keep challenging assumptions, and keep searching for those hidden gems in the market.
That's great advice. And on that note, we'll wrap up this episode of The Deep Dive. Thanks for joining us on this journey into the world of equity valuation.
Until next time, keep learning and happy investing.